Hi, I am Professor Suneel Maheshwari, professor of accounting at Indiana University of Pennsylvania. Today we'll be talking within the topic of income taxes about treatment of net operating losses. What is net operating loss, or what are net operating losses when they arise? Whenever there is a negative taxable income on the tax return, or that basically means your tax deductible expenses have exceeded the taxable revenues. So your taxable expenses have exceeded taxable revenue, so it creates a loss. The interesting part is there is no tax that needs to be paid on the net operating losses, that as everyone knows. So net operating losses, you don't incur any taxes, no taxes are payable. However, the tax loss permit, not only that no taxes are paid, but net operating losses can also be used to reduce the taxable income in the profitable year. That basically means you have the option to carry back the net operating loss for two periods or 2 years before the year in which immediate year before which the loss is occurred, or you can carry forward the unutilized loss into the future, or which creates a deferred tax asset. So whenever you've got the net operating losses, you've got the first option you've got is you can carry back that loss for 2 years. That is, you can reduce your taxable income for the previous years and get a tax refund, or which creates a receivable when we do the journal entry. Or you can carry back the loss for up to next 20 years to reduce your future taxable income. That basically assumes that you will be having, or that the deferred tax asset will be realized only if you have got the income on those future years. The option to carry back 2 years is given to you only during the year of loss, and if you decide not to carry back the losses, then you lose that opportunity. And the only thing that is left then is to carry it further 20 years. In a situation where the company is in the first year of operation, for example, and incurs a net operating loss of $125 million, in that case it does not have the option to carry back, because there is no taxable income in the previous years. So in this case, how do we report this $125 million of loss when the enacted tax rate is 40%? So in this case, the entire loss will be carried forward, and 40% of that will be recorded or will be recorded as a deferred tax asset. So $50 million will be recorded as a deferred tax asset, which will be realized over the future years, or which will help reduce the future taxable income when it arises, and reduce the tax liability at that time. So in this case, your deferred tax asset is created for $50 million. So deferred tax asset is debited by $50 million. And at the same time, you generate a benefit, income tax benefit, from that operating loss for $50 million. So please note that the benefit from the operating loss is recognized in the year in which the loss takes place. So 2016, this $50 million will need to be recognized as a loss. What does that mean? That basically means if you have a net operating loss of $125 million, then this $50 million of benefit will reduce that loss, and your loss will be shown at $75 million only for that particular year. So it has to be recognized in the year of the loss. Let's take an example. Placo had a before tax income of $100,000, both financial accounting and tax purposes in 2016, and also the rate is 40%. So Plexo had no prior taxable income for carryback. So not net operating loss will have to be carried forward. So take a minute to answer this question. In this case, make a choice. So if you were right, you would have chosen the last option because it created a deferred tax asset of $40,000 on $100,000 of net loss, or 40% of that, since it was they had no previous year of income, so there was no carryback, and at the same time you had a net loss of $60,000 because you got a benefit of $40,000. So there was $100,000 of loss less $40,000 of tax benefit derived from the deferred tax asset, bringing your net loss to $60,000. Let's take another example now. Please note that the figure that is more important is your total amount of tax, total amount of loss that has been generated, which is basically available to be written off in the future years or carried back 2 years. In 2016, there is a net operating loss of $125 million. The tax rate is 40%. And for 2014 and 15, you've got an income of $20 and $55 million. So in this case, you've got a total income over the 2 years of $75 million. So you've got enough loss to write off the income of the previous 2 years of $75 million and get a tax refund of the income taxes that were paid in that period. So in this case, you've got the $125 million of loss, and you are carrying back loss of 20 and 55 million. That was the maximum, that was the taxable income for those 2 periods. And the remaining loss is carried forward, $50 million loss is carried forward. So on the loss that is carried back, your tax refund is 7 and 22, that is what you paid during, or that is what the company paid earlier. So as far as $29 million is concerned, you will get a receivable on that. On the remaining $50 million, at 40%, you will create a deferred tax asset of $20 million. So this loss of $50 million will be utilized when you have got future income. So your deferred tax asset balance will be $20 million. So in this case, the receivables from income tax refund is debited by $29 million because you're going to get $29 million back. Then you've got a deferred tax asset of $20 million from that $50 million which you are carrying forward, and the income tax benefit is the total of both the numbers, which is $49 million. So in this case, you had a loss of $125 million. You've got a income tax benefit arising from carry back and carry forward for $49 million. So as far as the operating income before taxes is $125 million, and since you're saving $49 million, you'll be reducing that from $125 million to show a net loss of $76 million. So in this case, we had a $50 million loss carry forward. Let's assume in 2017 there is a $15 million income, and if we have got a $15 million income, since we have got a $50 million carry forward loss, we can write off that $15 million in income and have a zero tax currently. And then $35 million will be carried forward. That means 40% of that, or $14 million, will be the balance in the deferred tax asset account. Or basically we are writing $6 million on $15 million of, or realizing that deferred tax asset to the extent of $6 million. So your deferred tax asset is created by $6 million, and your income tax expense is debited by $6 million. So in this case, let's take another example. Shan had a before tax loss of $2,250,000 for 2016, and tax rate is 40%. There was a taxable income of $50,000 in each of the past 5 years. So that basically means for 2 years you can write off about $100,000 if you carry back, and elects to take the NOL carry back. As a result of that accounting, Blackboard will do what? So take a minute to read it and then decide what you want to do on that. So in this case, if you did it right, your choice would have been C. Why? Because for the previous 2 years, you've got $100,000 of net operating loss, which you can write off. 40% on 100,000 is 40,000 of tax refund that you will get. So that's the first part of it. And then the remaining will be carried forward. So you've got the remaining loss of $150,000 will be carried forward. 40% on that will be about $60,000, and that creates a deferred tax asset of $60,000. That's the calculation, and you've got the refund which is receivable at $40,000 and deferred tax asset of $60,000, and your overall tax benefit of $100,000. So in the net income, you'll have a net loss of $250,000, then a $100,000 benefit. So your income will show, your income state will be basically $150,000 of loss for the period. So deferred, as far as their classification and balance sheet is concerned, deferred tax assets and liabilities could be either current or non-current, and that is according to how they are related to the assets or liabilities. If it is a long-term asset and it relates to, say, amortization or depreciation, it is considered a non-current. Otherwise, if it is related to a current asset, then it will be referred to as a current deferred tax asset. Overall, you'll have to net out the current deferred tax assets and deferred tax liabilities to show them as an overall number. Thank you very much for listening to the presentation. Have a nice day.